Folks, in this video, I'm going to give you an example of how you would do common sizing across multiple periods, basically for the same firm. Again, I'm using Disney. In my case, I can get 3 years worth of information from Yahoo Finance. I think most of you can. You can use the other video to see how to get to and use Yahoo Finance. But if you go look under financials, you'll see income statement, cash flow, balance sheet. So there's your information. Um, really, nice thing about Yahoo Finance that I like is that you can do this. You basically highlight everything, copy it, and then you can just go over to Excel. And whether you need to pay special or not, that's kind of up to you. But in this case, that gets rid of all the formatting, and you now have it. Now, I already had a sheet set up here, and I've done the same thing with the balance sheet information in the other. I may go back and clean those up a little bit, but I'm just going to give an example here. So this again is called a common size income statement. And I'm going to go ahead and just grab these dates. And when you're doing a common size income statement, you do it off of revenue. Well, should have merged that, I guess. Sorry about that. That's probably going to make that work a little better. So when you do it off of revenue. So I usually will put the revenue numbers right up on top. That way I can just reference them in all my formulas. And then what I'm doing, and I'll just do it with a revenue number so that we can check the formula works right, should be 100%. So ratio, the common size is equal to whatever the particular account value is divided by whatever the revenue is. And in this case, we want to put a dollar sign in front of the row 2 because that's where all the revenue information is. And sure enough, when we do that across all of this, it's percentage, it's 100%. But now you can just drag this formula down. That's part of the sort of handy value of it. Now, obviously, there are some of these that don't have values that you can clean up if you want. I would recommend that you do that for yourself if you want to. But what we're really interested in from doing that is seeing the trends. And so remember, oldest to newest, so you got to kind of learn to look from right to left. Interestingly here, they've been managing to about a 54% cost of revenue for 3 years in a row. Suggests that that really is something they're managing to. Their SG&A was a little bit higher in 2014. They've managed to get that down by 2%, so doing a little bit better there. Operating expenses are sort of fluctuating here. I bet if we expanded that out a little bit, we'd find that's just rounding. Yep. So they're really managing their total operating expenses in a pretty tight band over the last 3 years. Their income before tax as a percent of sales going up a little bit, again, largely attributed to the fact that their SG&A has gone down. Income tax expense as a percentage of sales, not of income, right? Staying in about the same range. Minority interest, same sort of thing. A lot of these, again, if you were to expand the decimal just a little bit, you'd see that you really got a rounding going on there, and they're actually pretty darn close to each other. So not a whole lot going on in terms of that. Any other real insights here from them? Not really. I mean, aside from the fact that they've done a good job reducing their SG&A, and that's probably what's driven their operating income up as a percent of sales, not a whole lot of a story there. If we jumped over to their balance sheet, let me do this. Control C, paste. Let's do paste special. I'll tell you what, let's go back over to Yahoo, go get the balance sheet stuff. When I paste it without the text formatting, it seems to do a lot better. Kind of cleans things up for me a little bit. So we're going to do a paste special values, no formatting. There we go. And that didn't do anything, so we'll do it over here again. Paste special values, no formatting. So I'm just going to delete these. And you can see that when you do that, got to do a little bit of cleanup here. There we go. Now, those periods, because of the formatting, we lost the date. So we got to go ahead and get the dates back. There we go. They're the same as last time. You could have just grabbed them. Key here, same sort of thing as before. I'm just going to go grab the common size, all that sort of information at the top. Just makes it easier for me. This is a balance sheet though, so we'll say that. And with the balance sheet, you don't do by sales, you do it by assets, and it's total assets. So we got to go get that total asset number real quick. Let's see, I think I can, let's see if this works. Yeah, kind of scrunches everything together. That helps. And so let's see, total current, other total assets. So I'm going to put that amount up here as my scaling. And if you want to do that, those are scary big numbers by themselves. It's even scarier when you realize that all of these are in thousands. So they're talking about 84 billion, 92 billion in assets. But anyway, we go through the same approach. Just take our numbers, divide them by this $ in front of the 2 because you're locking in the same row. We want it on a percentage basis. Going to go ahead and expand that percent just a little bit so we can know when changes are. So cash, they're holding a little bit more cash on hand as time goes by. Let's just go look down these others. A little more cash. Looks to be that their receivables are just sort of staying in a similar range. Here's a trend. Their inventory is going down. I'm guessing they maybe are spending money on inventory management. And so, of course, that's going to, since that's a current asset, that's driving that down. But their total current assets is going up, primarily because of the cash, it looks like. And it's, a fairly big part of everything. So it just looks like that's going up. Let's see their liabilities. Looks like their accounts payable is going up a little bit. That might, I'm not sure how that relates to that their inventory is going down. Short-term debt kind of jumping around. You would expect that because it's really, stuff coming in due in a particular year. But, again, if we look at their total current liabilities, kind of went up, right? So primary things driving that, I mean, this is 1% change right there, which explains the jump from there to there. And quite frankly, you had very much smaller short-term debt. So kind of combined short-term and long-term is really driving that. Other things that you see that are sort of big and changing, obviously the overall long-term debt, we've looked at that. Minority interest kind of staying the same. Total liabilities have gone up. So their non-cash assets are going down, but their total liabilities are going up. Okay. Other things, let's see, common stock kind of staying at book value in the same range. Retained earnings going up. Let's see, they went up about 3% there, went up about almost 4% there, so that's a nice little trend. treasury stock. They bought back some treasury stock. So when they retained earnings went up, they would have used some of that money to buy back treasury stock. And so, when you look at it all together, it's like, not too bad. So at the end of the day, total stockholder equity as a percent of assets went down a little bit, partly because other stockholder equity is a negative value, it looks like. I don't know that for sure. But that's sort of an interesting development. And I'm assuming that's driven partly by this repurchase, the fact that the book value of equity has gone down. So there you go. You can do this same thing with cash flows if you want to. I'm not going to, but if you're going to do it with cash flows, you actually have a choice, whichever makes more sense to you. One, you could size them by net income, or you could size them by cash flows. Either one, I've seen it done both ways, but that's for you to do on your own. I don't require you to do it. Anyway, that's just sort of a quick demo of how you can both get the information, do the common sizing, and sort of look at it and get some neat little insights of what's going on your own. Appreciate it.